Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Hey, Kirk. Better late than never this week. We think we normally go Friday, and so everybody's getting a little midweek updates. That changes things a little bit.
Yeah, keeping everybody on their toes. I moved this weekend, so I've been, as the listeners know, I've been renting since 2020 and bought a place and moved in. So this weekend has been a whirlwind, and including yesterday, which I think we were originally supposed to do yesterday, but couldn't get that done because we didn't have the internet on time. It was supposed to do it yesterday morning, and Verizon just so I gotta love the Verizon Comcast of the world. So I remember back when I was just out of college, the cable signal coming out of the wall, they never turned it off. Like you could wait a few months before you called them because they just left it on. Now I moved yesterday the internet from Verizon from one house to another. They literally shut it off that morning because I was at my rental house to do the podcast and they shut it off. I'm like, what the heck? And then they turned it on later that day here. And anyway, so it is what it is.
Back in the day, they had to manually disconnect it. Now everything's changed.
Yeah, now they just, but I was thinking, I was like, why do you need to like cut it that close? But anyway, it is what it is. So apologies for being a day late, but we're getting to it. So, lots to talk about. Want to talk about a few things and a bunch of different concepts today. But one thing I want to talk about that we have this shutdown coming tomorrow, apparently, or tonight. We'll see what happens. It's always, I think by now, no one seems to care anymore. The first time this happened, I think it was under Obama where this really came to head the first time, and everyone was freaking out and the market flipped out over this. I forget what it dropped, but it was significant enough. And each subsequent time it's happened, the market's cared less and less. Because at the end of the day, if the federal government shuts down, do we really care? Elon couldn't have had it so good. The best thing that Trump could do is shut down the federal government. It would be great. They win. They get a budget surplus overnight, and everything's great. So if you want to shut off the deep state, sorry, couldn't make it happen. So I'm somewhat joking, obviously, but the point is we've already gotten accustomed to shutdowns, so it's not a problem anymore. People no longer worry about the shutdowns, so the market doesn't seem to care. And if you kind of look at the markets today, the markets are just fine. No one seems to care. Yeah, they're a little red in certain areas, but I don't think that's shutdown related. They're I would call them neutral. Not high, they're a little bit negative as of right now, but not highly so. Gold's still up, silver's down, orange juice up, indexes, they're all down a little bit. So it's really not too big of a deal. The market hasn't freaked out. Now tomorrow, you might think, oh my God, the market's going to go down. Yeah, maybe, or not. It's hard to say, right? I would guess no. Unless something significant happens, I'd guess no, because the markets just don't seem to care. So what does this mean to you? Absolutely nothing. This is just a circus, and this is the third ring of the circus that they're taking you on, and they're going to freak people out. And the best thing to do is really nothing, because even if the government shuts down for a week or 2 weeks, so what? Unless you're a part of the government, unless you're getting a salary, you might care. But for the normal economy, it doesn't really matter. People are still going to get paid. The people who need to get paid are still going to get paid. So here's what you also need to know. We're at the end of the quarter. Now, there are times in the market that you need to pay attention. And it doesn't mean something's going to happen, but it means if something is happening, this is a pivot point. Quarters, every quarter is a pivot point. You have, especially the third quarter is a pivot point. So the end of September is a pivot point. You might think, why the third quarter? That's a weird quarter. Well, here's why. Because a lot of companies, hedge funds, it's year end. If there's any sort of opening of the fund for people to withdraw money, it happens then. So if what typically you see is in years of distress, third quarters can be particularly precarious for hedge funds, because if they're not doing very well, you could have people saying, "Oh, I'm going to pull my money," and they all do it. And now you're up the creek. You're in trouble because now you got to sell stuff you don't want to sell, and it creates problems. So third quarter historically can be problematic. I don't think it will be this year, but there are certain years where it is. So that's something to be watch of. All right, pay attention to third quarter. Also, it tends to be a time where there's window dressing. A lot of funds do their window dressing at the end of the quarter, more so the third quarter, but definitely end of the year and third quarter. So the second most popular time is end of the year. The end of the year, the reason it's important is because when you do your year-end tax loss selling, it has to happen before the end of the year. So what happens? At the end of the year, if there's a sector that's gotten totally beaten like a redheaded stepchild all year, and it goes into the fourth quarter, you'll tend to see the low point right before. So, for example, if you go look at the chart for Bitcoin or Ethereum, those are the two I really track. I know there's more. But if you look at those two charts, where was the recent low in Bitcoin and Ethereum? Well, it was the end of 2022. So, if you look at Bitcoin, it hit a high of 65,000, and then it hit a low of 16,000. So that's about 70%, I believe. I think it was down around 70%, give or take. So that was the low. It was right before the end of the year. What happened? The first week of the year, it did really well because people started buying it again. So all the tax loss selling goes to the end of the year and drives everybody bananas. They're like, I got to get out. I got to get out. So if you're in a sector that is getting beaten over the head and you're like, I can't take it anymore, wait until after these inflection points, because typically if there's a turn, it will happen during these, especially if something is getting beaten up pretty good. So I would just make note of that. So when you're managing your portfolio and you're saying, all right, I need to get rid of this, just wait an extra day or two just to see if it turns around. If it doesn't, you can always get rid of it. So let me actually share this screen so you can kind of see. I didn't realize I wasn't sharing it. Oh, no, that's not it. Let's see, replace. Sorry, everyone. I'm going to bore everybody to tears with this. Here we go. All right. So here's Bitcoin. As you notice right here, at the end of 22, this is the low point. At 23, it starts to go up, right? This is, I bought some positions here because I knew, hey, if there's going to be a turn, it's going to be here. I didn't know if I was right. I wish I was a pig at this moment. It would have been great. Could have made lots of money, but it's just not how I did it. So it doesn't happen. It happened in Ethereum too, I believe. Well, sort of. Yeah, it was a low point. So, it doesn't happen with all assets, but it definitely happens enough where you should be paying attention. So that's something you should keep in the back of your mind. I wouldn't necessarily, sell all your portfolio at the end of the quarter or buy it or whatever you have to do. I wouldn't necessarily do that. But if you're think of it as a secondary framework. So your framework should be, do I want to own it or not? Now, if you're on the fence, it's something that might dump you over the edge. So it's just like one of the multiple frameworks you need to keep in mind. Oh, it's the end of the quarter. It's the end of the year. I think in 2010, when things were still rough after the great financial crisis, things were sloping down, and then I think it was like July 2nd. It was like at the end of the quarter. It was like, I'm sorry, it was after July 4th weekend. It was like July 7th. It just started to go up. So it was the end of the quarter, and you had the weekend, and it went up. So just keep that in mind if you're looking at things that can happen. It can cause inflection points. We also have earnings season coming up, which is starting next week, I believe. And I'm very curious how it's going to go. I think people are generally pretty optimistic about earnings season. So we'll see how that goes. This is a public service announcement. Hi, my name is Kirk Chisholm, and I'm with the government, and I'm here to help. Doesn't that sound reassuring? Well, let's talk about how they're helping. The government needs your help to make our money worthless again. PPP loans, student loan forgiveness, helicopter money. Let's keep the party going until our money is totally worthless. Don't think it can happen? Sure it can. Just ask Zimbabwe, Venezuela, Greece, Germany, Hungary, Greece, Yugoslavia. Did I say Greece? As a loyal listener to their show, I want to give you free money. I'm giving away free money in one of these hyperinflationary currencies. Go to www.moneytreepodcast.com/free money and follow the instructions to get your free gift. I have a large audience and only a limited supply of these currencies. I'm not the Federal Reserve, so I will run out at some point. Make sure you get yours before I run out. Go to moneytreepodcast.com/free money. Follow the instructions and get your free money today. Yeah, I got a bunch of charts to share today. Doug, you want to hit on anything before I jump into some of these fun charts?
I was kind of looking at a joke. I just want to touch on this, although you moved on a little bit. But one thing I'm sure that there is going to be some people out there that are going to think about impact of another shutdown. And that is something that we are becoming a little bit more accustomed to. There's actually been 10 shutdowns now, and I think in the last 20 years. The first time I remember the first time we had one, hit. It was, it was a significant reaction to it. 2013, we had one. It was October 1st to October 17th. It was 16 days. It was a standoff of the Affordable Care Act and continuing resolution legislation. We had another one in January 2018. It was only 1 day. It was very short. It was a funding gap, dispute over omnibus, budget deadlines, and bam, they were able to come to a fast agreement. 2018 to 2019 was a 35-day one. So it was a lot longer, and it was more of a dispute over border wall funding and appropriations. So that's, of course, 3 substantive shutdown events in the 2005 to 2025 era. There is, ultimately since post 1980, there's been about 10 funding gaps that have led to furloughs and shutdowns in the modern interpretation of shutdown. Well, when we take a look backwards and go further, and since 1976, there have been about 20. So we've had about 10 since 1980, and there was actually, 20, although not, funding gaps that only became full shutdowns. If we go back a little bit further. So this is something that we've definitely been through before. But the frequency of serious standoffs, weeks or days of disruption, does seem to have increased, especially since the 1990s and 2000s. It's become more of a political tool, brinkmanship device in recent decades. Many of the shutdowns have been short, few days, resolved quickly. The largest and most disruptive ones, 1995, 1996, 2013, 2018, 2019, still stand out fresh in public memory, and therefore a little bit more of a feeling of that economical, operational, political cost can loom larger. It could definitely have a GDP drag. So certainly, I mean, I think the one in 2018, 2019 cost an estimated $11 billion and some permanent losses. And the 2013 one, estimates suggested shaved off about 0.1 to 0.2% off quarterly GDP, which resulted in cost of tens of billions of dollars in lost output and government spending delays. There's a lot of other data around them, but the shutdowns also impose reputational trust costs. And I think that's the serious takeaway from these is that while, federal employees, what they consider non-essential, temporarily let go, they can't perform their functions. Essential employees typically can work, but there may not be immediate pay. Services can slow or stall to places like national parks, museums, regulatory inspections, grant programs, et cetera. So if you're looking for permits or visas, processing, those can all stall. So that could be something, if you're waiting on something or had plans, could be issues, for you to get things done, or maybe your vacation interrupted if you're looking at going to parks or places like that are run by the federal government. Ultimately, the biggest kickback on this political backlash, pressure on federal employees, disruption to contractors, et cetera. But the question is, and I really want to talk, is do we even care anymore? And it has definitely shown that the shock value of a shutdown is dulled. Serious categories of damage do remain. These shutdowns have occurred with regularity. Political actors have gotten more used to them. They're using them more often. So the public, I think, is becoming a little bit more desensitized, and that's creating more cynicism. Here we go again. Shorter shutdowns matter less in daily life, especially if there's like a weekend or holiday overlap. So many people don't feel the direct effects. But for those that are directly dependent on federal services, it's going to have real costs and uncertainty. And if we get into a big extended shutdown, there are going to be noticeable macroeconomic impacts. And the more prolonged they become, the more they could inject friction into government planning, debt markets, business decisions, and public programs. So it is definitely important to be aware of this. We do care. It may be less viscerally now than past decades, but there's, and the cost asymmetry is very real. Well-timed shutdown can have disproportionate leverage in budget negotiation relative to the pain that it inflicts in the short term. And, it's going to be very interesting to see, depending on the longevity of this, a good joke is this, you kind of threw it out there. Is this a way to get Doge without getting Doge? Right? If you want to have these cuts happen, well, there's talk today about, Trump has come out and said, kind of threat, if you shut this down, I'm just going to permanently shut down pieces of this. So it could give him the opportunity to get some of the things that he wanted to reduce in cost and programs. But it could create a lot of chaos in the process. So where it could help, and then I'll just turn it back to you. I mean, if we look at disruption as a leverage, all right, government can't have government working like this. We need sweeping reform. There could be a reallocation of priorities, pause or delay of oversight, and regulatory processes, that will, can slow down rulemaking, inspections, enforcement actions, ultimately there could be staffing changes. But, if this lasts longer, here's the real concern. What is the negative of it? The backfire hinder. Well, obviously loss of political capital. I mean, the party that's in control, and right now the risk to the Republicans is they own they run the House, the Senate, and the presidency. So a prolonged shutdown could damage the support of both in Congress, amongst the public, and ultimately the presidency, because typically who's in power, the public tends to blame the most. We could see economic drag or volatility. We've said this before, Kirk. Markets dislike uncertainty. Crypto markets, while volatile, could see sharp swings. And if confidence in government erodes, the risk premium tends to rise. We could see more regulatory gridlock. If the shutdown prevents, say, the passing of needed crypto regulation or oversight reform, that window could close. Some reporting already warns that a shutdown could actually delay some of these current crypto bills are in Congress. Even with aggressive intent, many agency functions, legal mandates, and oversight frameworks are still entrenched, and not all can be overridden by executive leverage. And ultimately, you may start to see litigation, pushback from stakeholders, resisting extreme moves. And I think that ultimately, no matter what happens, let's just hope that this isn't going to be a prolonged thing. And we've got some we've seen, right, the politicizing things the last couple of years have heightened. Hopefully, they'll come to some cooler heads and get through this quickly, because the data does show that if this does start to move into weeks, then, be prepared. We need to start having some defensive preparation.
Yeah. So I want to share a bunch of stuff. I think that's good context, and I think just keeping your head about it all is important. I mean, I stopped listening to the news about this stuff a long time ago because it doesn't matter. It's just a circus, right? It's like the old Coliseum. You know, they're throwing bread to the to the fans to get them to cheer.
Bread and circus.
Yeah, I mean, this is all a big circus, right? This is a big show, and you're watching the show, and they're putting on a show for you. And I personally think that the politicians, any given year they have a shutdown, they should not get paid that year.
Oh, that'd be great.
That's what I think. I know, of course, who's going to pass that? Because you're talking about themselves. So of course, they're not going to pass that. But frankly, that would get them to the table. And if the shutdown is a real purpose, now the shutdown is just an extension because they'll say, well, we'll just back pay you and we'll take care of it. So the fact that they can't manage their own budget, I think they should all be fired, every single one of them. And I'm not sure we'd get any better quality people, but I think, frankly, we need a better quality people representing us. Anyway, so let's kind of dive right in. There's a bunch of charts I wanted to share today because there's a lot of interesting stuff as I was going through in the last week. I was reading through, and we're in some interesting inflection points. So I saw this one. Now this is showing defensive stocks versus the S&P 500. Now I want to point this out because you may not know what a defensive stock is. There are a lot of frames on how people think about different sectors with the S&P, but typically, historically, defensive stocks are utilities, healthcare, consumer staples, and frequently financials. So the utilities, healthcare, and consumer staples are considered defensive. So if the market goes bad, let's just say you're managing a mutual fund, right? And you have to own stocks. You can't just go to cash, right? Let's say the market's going to crash. You can't go to cash. What do you own? You own defensive stocks. What are defensive stocks? Utilities. Utilities are basically the electric company. It's not going to change in value all that much. Consumer staples like Johnson & Johnson, like you're buying TP, you're buying Q-tips, you're buying cough syrup, like the stuff that basically it's not a luxury item, it's stuff you need. Food, right? Healthcare, you have to buy healthcare, right? You get sick, you got to go. So these are considered defensive names. And so the way to look at these are compared to the S&P, compared to all of the stocks, the defensive stocks are doing very poorly in comparison to everything else. Now, if you notice here, typically they kind of fall in a range on average of about 1. And if you look at certain times, and unfortunately the years got clipped, but this was during the great financial crisis. This was during the tech bubble bursting, I believe. I'm sorry. No, my mistake. This is January 2000 right here. The peak of it, the trough of this black line was January of 2000. And that was at 0.6. Right now we're at 0.7. This is the second lowest it's ever been. Now, if you look at other times, there really are no other times where it was this bad, unless you go back to like the 70s, way back. In the 80s, there was a time that was low, but this is really low, which means that people are not buying defensive stocks at all. And why should you? Because you're paid very well to take risk. Why have the Mag 7 done so well in the past 10 years? Because that's all people buy. They're going up. And hey, other stocks aren't following, but let's put it all on on Mag 7. Didn't mean to call it MAGA. And the Mag 7.
That's another chart, Kirk.
Yeah, it's a totally different chart. But the point is I'm not saying that this means that the market's going to crash. But what it means is at some point, things are going to start to revert. And when they do, it usually means that the growth stocks or the aggressive stocks are out of favor and people are looking for safety. So this is not a timing device. It's a relative, it's a relationship device. So a lot of what we do, because when we're looking at markets, we're looking at a lot of different things. And one of the things we look at are ratios. What are the ratios? Because there's normal ratios. If you look at this chart, you can see the normal ratios are 1. Right now, we're really low, which means we're way out of balance. What does that mean? It means that if things are out of balance at some point, they're going to revert to the mean because they have to. It's just the way things work. Could it be permanently broken? Sure, it could be. Is it? Probably not. Right? Everyone always says this time's different, but it rarely ever happens. I don't think it's different this time. It's just a matter of timing. I don't think this is a red light. Oh my God, make a change tomorrow. But it's definitely a yellow light. Like, all right, let's pay attention. Now, there's a few other charts here I wanted to show. So here's one that I've referenced in the past and finally saw the chart, so I wanted to share it. So this is basically an average year for the S&P and an average year for the VIX. Now, the VIX is a measure of volatility. Volatility is the up and down swings in the market. So when you have very low up and down swings like we have now, then the volatility is relatively low, right? And I don't know what it is today, but it's pretty low. Now, if you look at March of 2020, it hit the highest it's been maybe ever. I think it hit 80, which is really, really high. Generally, if it's under 20, it's pretty all safe. If it's between 20 and 30, it's like, all right, should probably sell some options here. Above 30, you know what's going on because it's all over the news and it's probably bad. So if you look here, generally this is aggregating a lot of data points over time. Now, if you look at the black line, that's the S&P. If you look at the red line, that's the VIX. Now it looks here like the low points are in July and August, which makes sense because no one's in the market, everyone's on vacation. And you also have December, same thing, everyone's on vacation. So those are the lower points in the cycle. The higher points, October, November. Well, that's where we're heading in now, which means a higher VIX means more volatility. It means probably the market's selling off. Something bad's happening, just like in March. So those are the times where the market hiccups happen. Now, if you look at the black line, the best times are up until June, and then it flatlines until pretty much October, mid-October, November, and then you typically have this spike again. So when they say sell in May and go away, there's a reason for that because the summer is just kind of not great. And then, of course, there's some bad months that usually happen in October. So just another framework to keep in mind with the overall context. Now, what I want to share now are some charts that are showing kind of what's going on in the world. Now, if you look at, let me just see here. I'm going to flip through some of these. This is not going to allow me to flip through. So, all right. So here's one chart. It's comparing the S&P 500 to a risk-on, risk-off indicator. We're not going to get into the details of how they define that, although that would be a good question to ask yourself. Risk-on, risk-off, how do you define that? Now, this is not like a uniform thing where everyone has the same standard. It's this person came up with it. I know CNN has their own version. The CNN version is not great. It's marginal. I'd say it's a coin flip. I wouldn't even look at it. Let's put it that way. But if you look at this, risk on, risk off. Risk on means, hey, take some risks. Let's go out there, put it all in black and take some risks. Risk off means, maybe I should sit down and take a pause for a while, right? So this is just something to look at. If you see these, this is what they mean. During these periods, you want to stay out of the market. If you see 2020, obviously, time to stay out. But then after that, hey, time to get in. So if you can find one of these that's reliable, great. I don't have any that I follow religiously because I have so many things. I kind of have my own. But it shows here that it's time to stay in the market. And I would agree. I would say it's a really hot market. I don't see anything disrupting. Even the shutdown is not disrupting it. I don't think anyone's going to care. Certainly, Trump's not caring. Trump's probably laughing at this point. I wouldn't be surprised to see a tweet out with him laughing at that. But regardless, I still think it's it's a potential risk. I just think the risk is low. All right. So here are different areas and year-to-date returns for this year. So I point this out primarily because if you look at the last 15, 20 years, the U.S. has drastically outperformed any other market. hands down. U.S. has been the place to be. This year, it has not been the place to be. It is one of the worst performing markets. It's not bad. It's just one of the worst performing markets compared to the rest. Now, if you look at here, what are the best performers? Europe x UK, then at 29.3%. Emerging markets are next at 27%, and Canada, that's a surprise. Then the UK, then Japan, then the Pacific ex Japan. So I want to point this out. So there's something interesting about this. You should say, wow, Europe's doing great. I should put all my money in Europe. Well, okay. The question is Europe still doing well? And the answer is, well, depending on which countries we're looking at, most countries were up 24% in the first few months of the year. So is Europe doing great? Not necessarily. It did. Is it still? It depends on the country. Some countries are and some are not. But I would just say, looking at these numbers, don't just naturally assume that they're going up all year, 2% a month or whatever it is. It's not. Most of the Europe profits or gains were in the first quarter, in the first part of the year, and then they more or less flattened out. So Japan has been doing well this year, especially for Japan. They've been in doldrums for a while. They've actually been doing well. Actually wanted to read something about Japan because I saw a really good article. I forget who it was by, so apologies to the owner of that. But I'll read it. So Japan's undergoing a market regime change. The Tokyo Stock Exchange has put an unprecedented effort into corporate governance reform. Companies are improving capital efficiency by returning unproductive assets to shareholders. Major indexes like the Nikkei are setting record highs. 38% of the market trades below book. 21% of the companies in Japan hold more than half of the market cap in net cash and long-term investments. Despite the rally, value trap reversal appears to have further run. All right. A prudent investor may be able to capture the balance sheet re-rating and keep your portfolio concentration, exit check, risk in check. Okay, let me explain what this means. The problem with Japan is for the last 30 years, with the exception of the last few years, Japan has been in a huge recession. Not like we experienced them, a slow decline, meaning like a slow ramp down over a 25-year period. Okay. Now, we don't do that in this country. We do it right. If it's going to be a decline, it's going to be a crash, and then we're going to have a boom, and that's just how we roll. That's not what happened in Japan. Japan had deflation, negative interest rates, all kinds of mistakes. It's only in the last few years that their stock market has started to grow. Now, one of the problems with Japan, if you look at the stocks from a fundamental perspective, they don't look. They look really great from a value standpoint. You say, wow, they're trading at book value for a company that's producing massive cash flow. You look at all these metrics and you're like, wow, these companies are great. Here's the problem with Japan, is this quote really accentuates. There's a corporate governance problem. And there's many reasons for this we're not going to get into right now. But there's a corporate governance problem in Japan. And there are many reasons for this, but one of them is that they have a lot of safe investments, cash or cash-like investments that they don't put to work productively in the business. Now, this is almost the opposite of what we do in this country. Some companies are buying Bitcoin in their treasury assets instead of keeping it in cash. So we do the opposite. They're looking for safety because they don't want to go bankrupt. They don't want to have bad periods. So they're actually very strong, but they're not productively used. So would a lot of these companies go bankrupt? Probably not. Just how they're run, because they're almost too safe. Would be the how I'd describe it. Like if you're looking for a company you want to grow, do you want a company that's too safe? That's what you're getting in many ways. So you're not getting the multiples that you'd get from like a big tech company or even a small tech company that are growing at 20, 30, 50% a year, because these companies really aren't growing, right? But they're safe. They're not going anywhere. So what Japan's trying to do is they're trying to reform and force companies to be more capital efficient. So pay out the cash to shareholders or invest it into things that make sense. But if it's unproductively used, they're trying to force these companies to get rid of the cash. I think that's really a bad premise, because at the end of the day, if they make them get rid of the cash and then a bunch of these companies fail, that's really dumb. That's usually what happens, right? When government oversight happens, they tell you to do something and that causes bigger problems because the unintended consequences. This is kind of one of those things. So I'm not sure that forcing anybody to do something is a good idea. But I think incentivizing to do it would be. I think coming up with incentives would be great. Japan has a long way to go on the upside if they start to become more efficient. I've been bullish on Japan for a while. I was early for a bunch of years, but I'm still bullish on Japan. I do think that they have a long way to go. There's definitely some stuff they got to work through, but for sure there's a lot that has to be done. So I think Japan's a good opportunity. I also wanted to point out the Russell 2000. So there is, I don't know why I'm getting like 3 versions of this in my screen, but anyway. So people have not talked about the Russell 2000 in a long time, and for good reason. Now, when I started in this business in 99, you looked at this 100-year chart and it would show, wow, what's the best performing asset over 100 years? Small caps. What's the worst? Cash. So it went cash, then bonds, then it went large cap, then small cap. If you wanted the best performance, you just put it all in small cap. So that's what people did. Small cap has not done very well, and this only goes to 2018. It's not done very well in the last 20 years. When it should have. The Mag 7 have done great. Small cap, not very well. Now, if you look at this, pretty much from 2018 until today, it didn't break above, in this, the IWM 170 until just after COVID. And it's been pretty much range bound for a while. Now, I want to talk about this from 2 perspectives, 1 from the Russell and 2 from a technical perspective. Now, I think this is a great chart that shows why technical investing is important. It's not that it predicts the future, it's that it helps you manage risk and it helps you manage entry and exit points. So if I'm looking at this, right, then I should have probably hedged or gotten out at 170 for these periods. Once it breaks it, I should be long the Russell until it creates a new top. And then that's the point you want to be careful, right? And then when it went back down in 2022, it retested the 170. That's a pretty strong hold, even though it was down a little bit, but a strong holding point. And then it's hit the top right around early this year, and then it went down, and now it's hitting the top. So for those of you who are audio viewers, apologies. I'm trying to explain the chart. Go to YouTube or get the pictures, get the screenshots on our website. But if you look at this, we've pretty much just broken through that ceiling. So there are resistance levels and there are support levels. So 170 was a resistance level before 2020, and then it became a support level after that. So once it broke through, it came down and hit support, and it didn't break through it. And now the resistance level is 242, which we just broke above. So the question is are we breaking through, and is this a start to a big rally, or is this a fake out? This is an example of something I would take a risk on. It's broken out. You might see a retest to the top. So this will happen frequently, where it will break out and then retest the line and then take off, or sometimes it'll just break out and keep going. Once it breaks out, it is a good probability trade from a technical perspective to buy here. And then if it breaks below there, you get out, because it's what you call a bull trap, and you just get out, and because it's probably going to go the other way. Now, if you're a good technical trader, you'd probably short it here because you're going the other way, because that's typically what would happen. But I'm not a big fan of those. I look at this and say, all right, once it's broken out, let's take the risk. If it breaks below, you can sell it. But it looks to be here like it's got some room to run. And since it's been range bound for so long, I would expect that we have quite a bit of room to run here. So I think I would guess you're going to get 20 to 30% easy on this if it continues, just to be clear. None of this is a science; it's an art. So you have to read the tea leaves a little bit. But a lot of people make a lot of money on technical investing, so it's worth learning. Even if you're a fundamental investor, it's worth learning the technical stuff so you can look at entry and exit points because otherwise you bought in 2021, you've been sitting on dead money for the last 5 years when the mag 7 have been taken off and Bitcoin's taken off and gold's taken off. You basically just made no money for the last 5 years. So rather than waste time, get to know how you can use technicals as an overlay for what else you're investing in. So I bring this up because the Russell is something to pay attention to. We've been talking about gold for the last bunch of weeks. Now we're talking about the Russell because the Russell is important. And I also want to mention one more chart, and I'm going to give it back to Doug. But pay attention to the Russell right now. Very, very important. And then the small caps are really starting to take off, especially some names. I also wanted to point this one other thing out because if you're looking around, here's a similar one with Ethereum. So here's what happened. Ethereum broke out above the 4,000 level, and it didn't start to take off too much. It did, and now it's retesting it. That's not a good thing. It's a good thing that it's retesting it. It's not a good thing if it breaks below. So if Bitcoin's got the same, I don't have a Bitcoin chart, but they're at these support levels. So if it breaks down below this, it's a bad sign. Get out. Right, just get out. You can always come back, right? But just get out because it means it's going to go a lot lower. It means it's a fake out and not good news. You just wait. Bitcoin's got the same, so just be careful. However, as long as it stays above, you should be bullish. Even though it's retesting it, that's okay. That's a good thing because if it retests and bounces, that's a good thing. See this? It retested here, bounced really high. Went here and it just kind of kept. And if it retests and bounces, I'd be in good shape. Now, if it stays on the line, be a little cautious, but just something to keep in mind. Like I said, Bitcoin is the same. I'm not going to show that chart because it's the same thing. Actually, I will because it's right here. So same thing here. I'm not going to get into VWAP, but basically you got the same chart with Bitcoin. So just something to pay attention for both of them. If you're looking to take profits and it breaks down, it'd be a good time to take profits. Otherwise, just ride it. We are heading in to another volatile month in October. November, December, January tend to be great months. So I expect we might see some volatility, shake some people out, and then we'll be on a rocket ship ride. So just I would make sure you have some cash aside right now for the next month because if things get rocky, you want to be able to put it to work. So that's one thing I would do. And the last point I want to make before I hand it over to Doug to wrap it up is this chart. Now, I find this chart funny. So back in the teens, before COVID, everyone was afraid that the world was going to heat up and the ice caps are going to melt, and all the polar bears are going to die because they won't have any ice to stand on, even though they're great swimmers. I don't understand that, but anyway, the crazy part of the green movement was going cuckoo, and they wanted to close all the coal plants. So what happened? Well, here's what happened. Coal was becoming out of favor because people were they were in favor of clean energy, which is fine. Everyone goes through trends. So they were anti-coal. So what happened? Coal went into the toilet. And so what happened is, and this happens a lot, by the way, is it kept going down, down, down. And what happened? It hit a bottom, and right around the bottom, it started to delist. So this was the only coal ETF I was aware of, Van Eck. It was KOL, and I used to follow it. And I was thinking, hey, this would be a good time to buy it. And what happened? They delisted, which means they took it off. You couldn't invest in it anymore. They basically gave you your money back. Well, what happened? It went on a historic bull market. So anytime you see an ETF delist, it means that no one's paying attention to it. Everyone just hates it. There's no one buying the ETF, and the ETF company is like saying, hey, I'm not making any money. Let's close it down. It's not a conspiracy. It's just, hey, we're not making money. No one wants this thing. Let's shut it down. Well, the best thing to do, go buy a bunch of coal stocks. It's just the nature of things. Wall Street goes through trends. You buy things that are out of favor. When this is one of the biggest markers of being out of favor is an ETF delist because of a lack of investors.
On the way up, by the way, got delisted on the uptrend. Perfect.
That's only because it takes some time to delist.
Of course, no, but that's my point. Yeah, it's like by the time they decided they didn't want it anymore, it had already reversed.
And the funny thing is, people still weren't investing in it, even though it was taken off. So you don't need an ETF. Go out and figure out what they owned and buy a bunch of coal stocks. You don't even have to be good at picking stocks. Buy them all. Buy 20 of them, right? You don't have to be a rock star. There aren't that many coal stocks. Like there's probably 10 that you would consider, and maybe 6 are good. So just go buy all 10. Who cares, right? You would have gotten the index. So you would have made great returns, hit a low of 3, and right now it's at 31. So you would have been doing okay. Point being is going against the grain is a good thing for your portfolio if you're smart about it. Because you could have been really dumb about this all the way down and kept buying, you would have lost a lot of money. But if you just wait until it turns, you don't need to buy it at 3. You could have bought it at 6. You could have bought it at 7. You still would have made a lot of money. At 7, you would have still made a 5. You would have made almost a 5% return. I'm sorry, 500% return. Who cares? You would have made a great return. So point being is watch for these things. They're really important to recognize. And then you can make determinations if you want to buy it. But like I said, you have to, like, small caps out of favor. I haven't wanted to touch it, but now that's breaking out, I'm looking at it. It's the only reason I'm looking at it. It's the reason I'm looking at Europe is because it's broken out. It's the only reason. It's been in the doldrums forever. So keep watch of things. Don't get too eager and jump in just because, just because it's going down or whatever. Wait till it starts to have upward momentum, because otherwise you're going to sit on dead money for a long period of time. Doug, you can wrap us up here. Take us home.
Sure, and I'll take it as just a little fun history lesson on coal. All the coal that has ever been made, that will ever be made, has been made. I don't know if you know how coal was formulated, Kirk.
Diamonds, Doug. It came from diamonds, right?
I wish. Coal turns into diamonds. You got that one a little bit reversed right there. I actually had a question about this with my scouts this weekend. So interesting history of it. And this is, again, some of you out there might believe in evolution. Some of you might not. But when lingam, I think is what it's called, was first created within plants, that allowed trees to form that structure and allowed plants to be able to grow to the heights that they did because that structural rigidity. When they died, there was not a single thing on earth that could break that down. It was incapable. There was no fungus. There was no bacteria. Nothing could decompose it. So when those trees fell, that wood just sat there, and eventually over time, pressure and heat. Well, and that's how we got coal. Now, through evolution, eventually mold and fungus started to be able to break down this lingam. I don't know if I'm pronouncing it right. And eventually that allowed wood to rot. What'd you say?
Good enough.
Exactly. Allowed wood to rot. Anyway, long story short, we're already starting to see bacteria that are evolving to eat plastic. So fingers crossed, the cycle of how long it took millions of years for them to figure out how to break down trees. Now it looks like we might only have decades for bacteria to figure out how to break down plastic. So anyway, a little history lesson there. Shutdown. So obviously, if coal, and I do want to add this one thing about coal, they have pulled back on a lot of green energy initiatives. All of those incentives, those tax incentives, a lot of them are going away through the one big beautiful bill. And if you don't think that's going to make green energy more expensive, guess what? We've been talking about whether we all want a clean planet, how we get there. If you don't think that some of these things like coal are going to get more popular because again, people need cheap energy, the timing absolutely correlates. And now, just to kind of round things out there, we talked about shutdowns, talked about politics, markets. Honestly, the noise never stops. Sure, the markets can be resilient, but resilience doesn't erase risk. What matters is structure, timing, and discipline. So here's the truth. If you're building wealth, that's one thing. Protecting it and keeping it work for you, well, that takes another level. And it means keeping losses small, buying when assets like coal are undervalued, and refusing to chase when they are overheated. Risk mitigation and timing aren't optional. They're the difference between compounding growth and compounding mistakes. So heading into Q4, these lessons are even sharper. With volatility potentially rising, rotations happening under the surface, rates pressuring income assets, the investors who win will be the ones who keep some cash ready, control their downside, and then step in when value actually shows up. The same principles are going to apply to retirement income and to college funding. Too many affluent families assume that their net worth is just going to take care of tuition, or it's going to eliminate those retirement gaps. They leave these dollars exposed. They sit in the riskiest part of the portfolio. Just saw something where an 85-year-old was 100% aggressive growth. You know what? That's great until the bill arrives. And then a market stumble doubles the real cost, and it chips away at the retirement income that right now a lot of people think is untouchable. Scenario after scenario is going to prove it. It's not the downturn you see coming that does the damage. It's the one you ignore, the one that sneaks up and wrecks the harvest. So you need to ask yourself, are you working with yesterday's playbook, assuming the market will cooperate, or are you building a structure that shields things like tuition, income, lifestyle by cutting those losses early, buying smart, and staying prepared? If your gut says something's off, trust it. Be early to the trend of smart money. If you want to learn a little bit more about how we do it, visit mergentadvisors.net. That's MERGENT, MERGENT, mergentadvisors.net. Or specifically, if you want to get ahead of the curve of how much college cost is eroding your wealth and you want to be a smart money family around college, most planners don't address this, but check out our information at mergentcollegeadvisors.com. Let's build a plan that keeps your cash ready, your risks contained, your life on track, so you can live it the way you want. Hey, no matter what Q4 Washington throws at it.
Awesome, Doug. Well, appreciate you you coming on the show here and sharing your wisdom with us. And we're gonna wrap it up. Hopefully next week I might have a different background once I have my wall here configured. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.